Chapter 2: Microstructure of Equity Markets. For our introduction, equity market microstructure is a relatively new field in financial economics that deals with the processes by which orders to buy or to sell shares are submitted to a marketplace and turned into trades and transaction prices. These processes are not simple because they involve human intermediaries, electronic technology, and a detailed rulebook. The trading decisions of investors who turn to the market to implement their portfolio decisions are not simple either. However, although the assumption is not always explicitly stated, the marketplace in standard financial and economic analysis typically assumes a perfectly liquid, frictionless environment, and the complexities of real-world markets are typically not considered. The perfectly liquid, frictionless environment assumption simplifies both model building and classroom discussions. Consider, for instance, the capital asset pricing model, or CAPM, a cornerstone of modern portfolio theory. The main CAPM assumptions are unlimited borrowing and lending occur at the risk-free rate, shareholdings and share prices are continuous variables, individual portfolios comprise an unbounded number of stocks, all participants have the same underlying information set and form identical or homogeneous expectations, and no one participant is large enough to affect prices. In this environment, share prices and expected returns are set with reference to just one variable, a stock's beta coefficient, which measures systematic risk. This chapter is structured as follows. The first section of this chapter provides a look at a frictionless equity marketplace, focusing on two of its features, the perfect liquidity and share prices following random walks. The next section is the equity analysis of a non-frictionless world. The third section is a whirlwind tour of the microstructure literature, then intraday price volatility, a measure of market quality, and raising capital through markets, and then the summary and conclusions, and lastly, the references. Let's now proceed to a look at the frictionless marketplace. A frictionless market is a theoretical trading environment where all costs and restraints associated with transactions are non-existent. Examples of products with market frictions are oil, which involves high and uncertain exploration cost, and street parking, which requires the conversion of an initially public good into a paid-for commodity. There are two key features of a frictionless equity market, the liquidity and the random walks. This section begins by considering these two concepts. The liquidity is commonly viewed as the ability to buy or sell shares at a reasonable price, in a reasonable amount of time, and reasonable quantity, while in random walk is a property of the perfectly liquid and efficient environment. Liquidity in the CAPM framework, the prices adjust immediately to new information, and they are always accurate trades are made instantaneously at zero transaction cost, and because they are atomistic, participants can trade in whatever size they want without affecting market prices. In this perfectly liquid, perfectly efficient, and random walk environment, CAPM models the determination of prices and the distribution of expected returns across assets that differ in one factor only, their beta coefficients, which is CAPM's measure of non-diversifiable or systematic risk.
Equity analysis of non-frictionless world. Investment decisions are acted on by sending buy and sell orders to a marketplace, where they met and are translated into trades. Equity market microstructure focuses directly on this implementation of investment decisions, as stated in the functionally has Reka, Reich, and Schwartz. Length fundamental information concerning equity valuation of primary concern to portfolio managers to prices and transaction volumes that are realized in the marketplace. The quality of the link depends on the rules, procedures, and facilities of a securities market and on the broader regulatory and competitive environment within which the market operates. Microstructure analysis of the implementation process yields insight for: first, developing the architecture of market structure; second, formulating trading strategies; third, testing market efficiencies; and fourth, understanding the processes by which new information is translated into security prices. Given microstructure focus on the operation of a marketplace, understanding marketplace function is important. Market. It is a place, real or virtual, where buyers and sellers meet and transact with each other. So market is a process and it exists when a group of buyers and sellers communicate to exchange goods and services. It is a place where buyers and sellers are physically present to purchase and sell goods and services for a price. Function of marketplace. Function of marketplace is to discover two things, price and quantity. In traditional economic theory, in a competitive market, price and quantity are discovered simultaneously with price on the vertical axis and quantity on the horizontal. Optimal values for these two are given by the intersection of a market demand curve and a market supply curve. Price. Price is the amount of money that a buyer gives to a seller in exchange for a good or a service. And quantity, the quantity is refers to how many of something there is. It's measurable, countable, and typically expressed in a numerical format. Business often use quantity as a standard for successful production practices. This is not so straightforward in real-world markets. Price discovery and quantity discovery in a real-world market may be anything but a simple process, as can be seen with reference to an equity market. Consider the facility typically used for trading shares of a listed security, a continuous order-driven limit order book platform. In this environment, share prices are set while transactions are being made, with outcomes depending on the orders that traders have submitted. Other considerations include the specific types of order, accepted transparency rules, and the use of intermediaries. Additional structural alternatives include a quote-driven market, call auction, and various types of block trading facilities. This presentation of equity market microstructure has emphasized the basic economic function of a market and the architectural structure of the marketplace. The microstructure literature, however, is in some respect broader and more detailed than the discussion might thus far imply. A whirlwind tour of the microstructure literature. The term microstructure was not coined until years later. The microstructure literature first started to develop in the 1970s, following the production of the Institutional Investor report by the Securities and Exchange Commission in 1971. Influenced by this report, the early literature focused largely on the operation and profitability of dealers and exchange specialists. The service provided by these intermediaries was taken to be immediacy, and the bid-ask spread was taken to be the price the market makers charge for supplying immediacy. A key question addressed and answered for the most part with a no was whether a competition was sufficient to keep intermediaries' profit at reasonable levels. Quite naturally, this early literature led to developing dealer pricing models which provided much of the foundation for further microstructure studies. The dealer literature developed along two lines: inventory-based models. The first set of the study, financial economists analyzed cost setting with respect to a dealer's inventory control. That is, a dealer with an undesirably large long position would lower his quotes, while a dealer with an undesirably large short position would raise his quotes. Asymmetric information-based models. The second set of studies, financial economists analyze quote setting with respect to controlling the cost of dealer in course when, without knowing it, the dealer transacts with a participant who has information the market maker has not yet received. The advent of the asymmetric information model did much to expand and straighten the microstructure in literature. The asymmetric dealer literature also led to another major development, an understanding that for a dealer market not to fail, It must comprise liquidity traders and the noise traders. Liquidity traders is wishes to trade a fixed number of shares within a certain time horizon and to minimize the mean and variance of the cost of trading. The noise trader is a participant who trades on the basis of price changes as if they contain exploitable information. Market makers require the presence of liquidity traders so the profit they realize when trading with this class of participants can cover the costs incurred when they transact with a better informed participant. The literature also establishes that noise traders are also required for a market to not fail. From these beginnings, the microstructure literature has experienced a sizable expansion. The more important development includes microstructure analysis of both order-driven and code-driven markets, periodical auction trading, where multiple orders are batched for simultaneous execution at the same price and at the same point in time. In contrast with continuous trading, with a transaction is realized whenever a buy or order meets or causes a sell order in price. Technology developments including, in particular, the advent of electronic trading, technology developments including, in particular, the advent of electronic trading, market characteristics such as transparency and the consolidation versus fragmentation of order flow across alternative trading venues. Market quality characteristics such as the size of bid-ask spread, market impact cost, intraday returns, autocorrelation, and intraday price volatility. Econometric techniques for assessing market quality and for decomposing price changes into informationally justified, efficient price changes, and microstructure noise. A spectrum of international markets, liquidity as an attribute of markets and a determinant of expected returns. More recently, the literature has taken account of another reality of an equity market. Investors have divergent expectations, while the homogeneous expectation environment is simpler to analyze. The assumption is patently unrealistic and making it surprises some issues that are of major importance from a microstructure perspective. In particular, the price discovery function of marketplace and the accentuation of intraday price volatility. Of key importance is the fact that price discovery is a complex, protected process in a divergent expectations environment, and so transaction prices commonly differ from equilibrium values. This even without bid-ask spread and market impact effects. Share prices do not follow random walks. Following information changes prices will at times under adjust to the change. At other times they will overshoot new equilibrium values to which they then men revert.
Intraday price volatility, a measure of market quality. A frictionless market is an ideal world that investors may persistently strive to achieve but can never totally attain. In real-world financial markets, frictions introduces transactions costs that include explicit costs such as commissions and trading fees, and implicit costs such as bid-ask spreads and market impact. Frictions also induces errors in price discovery. Collectively, these irrealities manifest themselves in accentuated intraday price volatility. If price changes are independently and identically distributed, the equation below describes the relationship between shorter and longer run volatility. where R is the logarithmic return over the longer interval L. T is the number of short period intervals in one long period, and R is the logarithmic return over the shorter interval S. This equation shows that in a fully efficient random walk environment, volatility increases linearly with T, or with the length of the measurement interval. When relaxing the assumptions of perfect efficiency and random walk, the autocovariance of short period returns enters the picture. Now, following Hasbrook and Schwartz, the time variance equation can be written as where COO close parenthesis RS1 RS dot 1 plus is the autocovariance in short period returns separated by 5 periods. 5 equals 1. If the covariance terms are in aggregate negative, then var close parenthesis R dx var close parenthesis rs, because the covariance terms apply predominantly to interdependencies in short runs returns. This inequality can be viewed as an indication not that VAR or close parenthesis R is dampened, but that var close parenthesis RE is accentuated. The covariance terms are predominantly attributable to the three aforementioned factors: spreads, market impact cost, and price discovery errors. Each of these factors introduces mean reversion in prices and hence negative returns autocorrelations. A large body of literature documents the accentuation of intraday volatility. Besides, Hasbrook and Schwartz, other more recent research exploring accentuated short-term volatility and its link to execution cost includes Lowe and McKinley, Fleming, Remolona, Stoll, and Bessembinder and Rath. Additional studies include Melnish and Wood, 1984, who conduct minute-by-minute analysis to measure the lead-log relationship between intraday returns of individual stocks and market indexes. They find that intraday returns exhibit a U-shaped pattern. Wood, Melnish, and Ord, 1985, show that the variability of index return across the trading day displays a basic U-shaped pattern. McInish and Wood, 1990, further observed that the variance of intra-minute returns across stocks is higher at the beginning and at the end of the trading day compared to the intervening hours. Kim, Lockwood, and McInish, 1998, find that intraday stocks let us follow a similar U-shaped intraday pattern. Pera, Schwartz, and Wolf suggest an explanation for the U-shaped intraday pattern. These authors contend that transaction prices are perturbed by price discovery errors, and these errors translate into accentuated volatility, especially at market openings. Pagano, Peng, and Schwartz, 2013, working with returns data from NASDAQ, or National Association of Securities Dealers Automated Quotations stock market, also assess opening and closing volatility. They're finding that NASDAQ's 2004 introduction of opening and closing call auctions reduced the volatility accentuation, led them to suggest the accentuations can largely be attributed to noisy price discovery. Price discovery has received inadequate attention in the literature because of the widespread view that similarly informed investors will form homogeneous expectations, and thus stocks have uniquely determined fundamental values that can be found in the upstairs offices of stock analysis. When this assumption is relaxed, similarly informed investors from divergent expectations, so stocks cannot have uniquely determined fundamentals values, and equilibrium prices can be found only in the marketplace. Thus, in the divergent expectations context, marketplace-based price discovery is non-instantaneous and noisy, and the noise translates into accentuated intraday price volatility.
Opening volatility for the NYSE, Nasdaq, and ISE. The New York Stock Exchange, or NYSE, the biggest marketplace in the world for investors to buy and sell shares of stock. National Association of Securities Dealers, Automated Quotations, or Nasdaq, the second largest stock exchange in the world for investors looking to buy and sell shares of stock. The ISE, it is the primary stock exchange of Turkey. More than 700 financial services providers and commodities brokers participate in the exchange. More than 500 companies are listed on the BIST. A good way to measure intraday volatility is to look at the extremity of price fluctuation in a given interval. Therefore, intraday volatility is measured as the percentage difference between the highest and the lowest price in a given measurement interval. As Exhibit 2.1 shows, intraday volatility in the opening 10 minutes of the trading day for NYSE stocks has more than doubled in the last decade. Comparing the NYSE and Nasdaq, the other major US stock market, shows that opening volatility has historically been higher for Nasdaq stocks. However, by the end of the last decade, NYSE stocks opening volatility had increased to similar level as Nasdaq stocks. On the ISE, volatility levels have been improving using ISE 100 index data from 1996 to 1999. Buildic 2001 shows the intraday volatility is higher at the opening of both sessions at the ISE. We find that the average opening volatility it was 1.69% in 2000, which decreased to 0.98% by 2005, and then fell further to 0.93% by the end of the decade. The US markets in recent years have fragmented in three different dimensions: spatially, temporally, and in price. First is the spatial dimension, refers to the fragmentation of orders flow across multiple trading venues. Electronic intermarket linkages tie different markets venues together, but nevertheless, coordinating orders and the accuracy of price discovery may not deliver efficiencies that are comparable to what a single consolidated facility can achieve. The second dimension is temporal fragmentation. The speed with which trading occurs has accelerated, and the ability to measure with precision the time of order arrival has become formidable in today's electronic markets. Whereas time used to be measured with more or less a few seconds precision, time is now measured with millisecond precision. With the slower time clock, if a slew of orders arrive in a burst and the sequence of order arrival could not be determined, the orders will be pulled together for simultaneous execution in a call auction. With the faster time clock, the sequence of order arrival can more accurately be determined, and those trades can be made sequentially as they habitually are in continuous trading. But for all intents and purposes, the sequence of trade arrivals in sub-second interval is devoid of economic content, and splitting the trades apart temporally fragments the market. The third dimension is fragmentation across price points. With the reduced tick size, participants are more encouraged to jockey for position in the price time, priority trading queue, and fragmentation of orders over many price points can, as with the first two dimensions, undermine the efficiency of order coordination. In so doing, fragmentation across the price points disturb price discovery. A presumption is that the combined effects of technology and regulation by fracturing markets, especially temporally and in price, have in large part at least accounted for the changing intraday volatility pattern that we have observed. In assessing market quality through price efficiency, considering only commission spreads and market impact cost is insufficient. The quality of price discovery is also major importance since an elevation in intraday price volatility can be considered an indicator of noisy price discovery, analyzing, and monitoring. This volatility level, in addition to the other market quality measures, is imperative.
Raising capital through markets. Properly functioning equity markets provide substantial and widespread benefits for an economy. Such markets are an important source of long-term financing for companies because they allocate capital efficiently, disperse risk, and reduce vulnerability to bankruptcy. These advantages make public equity owner an important element of a global financial system. Equity markets enable growth by efficiently channeling money to the best performing companies. Persuasive empirical evidence suggests that if legal protections for shareholders are strong, financial system including robust capital markets in addition to bank finance will promote faster and more stable economic growth. Moreover, when the global economy is still struggling to recover from the collapse of the credit bubble, greater use of debt, whether from banks or through capital markets, would be the most unwelcome. Public equity dispersed corporate ownership gives companies resilience in downturn and is a highly effective shock absorber. By contrast, highly leveraged increases the risk of the bankruptcy and makes the world economy more vulnerable to shock. There are 7 key advantages of going public. First, access to capital. Public placement of shares on a stock exchange enables a firm to obtain capital at lower cost vis-a-vis the alternative of remaining private and turning to a bank or private investors for funds. Lowering the cost of capital stimulates both organic growth and acquisitions. If retained earnings and debt fundings are insufficient, an IPO is an excellent way to continue to grow a business. An IPO provides access to massive, timeless, and relatively cheap pools of capital that do not have to be repaid and that do not involve an obligatory interest charge. The payment IPO investors seek is an appreciation of their investment and dividends. Going public also provides a public valuation of a company that, among other things, enables company to undertake mergers and acquisitions because it can offer stock rather than cash. Second, improvement in debt finance terms. A company listed on a recognized stock exchange is more reliable, especially in countries with low transparency businesses and typically inadequate financial reporting. Bank and other suppliers of credit are more likely to extend loan to more transparent public companies. Thus, additional debt capital can be obtained with less collateral, longer maturities, and lower interest rates. Third, creation of liquidity. One of the most important gains of going public is that a public market for company shares creates liquidity. Trading shares in an organized exchange brings substantial cost saving for shareholders by enabling shares to be bought and sold with relative speed and lower transaction costs. The liquidity is also enables initial owners to sell their shares in the secondary market. Next, enhancement of the company's public profile. By listing on an recognized stock exchange, a firm receives far wider and usually favorable media coverage that increases its visibility and public recognition of its product. The professional financial analysis reports cover the listed company's activities, which supports the liquidity of its shares and contribute to expanding its business contacts. Listing on an exchange, an advertisement for the company increases investor awareness of its product and its securities. Next, portfolio diversification and change of control. Portfolio diversification is another benefit of going public. With listing, major controlling shareholders of a firm can exit and reinvest in other assets. This is particularly important for closely held family firms. Next, reduce agency problems through market discipline. Listing adds discipline for management that decreases agency problems between shareholders and managers. The reflection of information in stock prices enable both shareholders and managers to be better assess a firm's performance. Market-based corporate valuations are also used to design more efficient managerial compensation. Equity-based compensation incentives key personnel to be more efficient and better advance a company's growth. Equity participation remuneration also enhances employee loyalty, thereby facilitating the retention of key personnel. And last, institutionalization and increased confidence. Exercising due diligence during an IPO requires the comprehensive analysis of a company's business model. Internal changes occur during an IPO implementation, including the modification of organizational structure, selection of key personnel, and an overall evaluation of a firm's efficiency. This effort can markedly improve a firm's communication system, management, and controls. The processes, standards, and regulations that are required for listing on an organized stock exchange further increase the quality of a company. Partners take additional comfort in a public company having gone through rigorous legal, financial, and corporate due diligence. The ISC focus on and experience with capital raising. With its record economic growth rates and strong macroeconomic indicators, Turkey continues to consolidate its place among the most rapidly developing country in the world. But because its corporate growth and the expansion of its capital markets have not continued at the same pace, a competitive disadvantage vis-a-vis other developing countries will undoubtedly result. For companies to sustain themselves and grow, access to capital markets is important. The ISC IPO initiative and focus on education. The goal is to increase the number of publicly held companies to 1,000 by 2023. The agreement offers companies more opportunities to procure funding for projects and to become more competitive in a global environment. The Turkish Exporters Assembly hopes the increased financing options will improve its members' corporate leadership, shareholder value, governing principles, due diligence, transparency, and corporate structures. It has held seminars and other activities to educate its members about the financing opportunities offered under the term of the agreement. Problems getting private companies to go public. Based on the survey that ISC conducted, many companies lack sufficient information about the benefits of being traded on an organized exchange. ISC contracted a roadmap to deal with the problems, concerns, and requests of the private companies. Concurrently, the ISC reviewed existing regulation to facilitate and accelerate public offerings, and it continues to revise regulation to meet companies' needs. The ISC has reduced IPO fees and simplified the listing process. With these reforms and with strong macroeconomic growth, a substantial increase has been realized in the number of public offerings with a larger issuance of private sector bonds, warrants, and cover bonds. The ISC chairman and executive management found serious misperception about the capital markets and the ISC. A major misconception of several Anatolian companies was the belief that the ISC is a Istanbul stock exchange, that it serves only companies from Istanbul, and that they have no place there. Positive outcome of ISC's IPO initiative. In 2010 and 2011, the number of IPOs more than doubled to 23 and 27 respectively. This shows the positive outcome of the IPO initiatives. The fact that 18 companies went public and started trading on ISC in the first 6 months of 2012 confirms that the IPO momentum remains robust despite negative investor sentiment in global financial markets. Beside ISC's first national market, which is for the shares of companies that meet the listing and trading requirements of ISE, other market segments exist for companies of different sizes and profiles. The second national market is for small and medium enterprises that fail to meet the listing requirements of the first national market. Listing on the second national market is an initial step to the first national market for companies that do not initially meet its listing requirements. Further, an emerging companies market or ECM has been established for very small and medium-sized companies that have yet to meet the requirements for the ISE stock market. Market advisor institutions have been established to support the small and medium-sized company. The IPO and transaction costs collected by the ISE, CMB, and the Central Registry Agency for ECM were reduced to 10% of the standard fees, and the ISE did not charge for ECM admission until the end of 2012. Investor preferences. Adequate public participation requires not only a large enough national savings rate, but also a meaningful percentage of savings directed to equity investments. For the latter, equities compete with the other established assets such as bank deposit, gold, and real estate, and appreciable investor awareness and education are required for the equity market to meet this challenge. To inspire investor confidence, exchanges also need rules and regulations that protect them, provide transparency, assure easy access, and offer sufficient liquidity. Additionally, creating different markets for listing various sizes of firms, a product differentiation strategy, will attract retail investors. As countries have grown richer, investors have become more willing to put money at risk in equities to achieve higher return. However, many factors must be in place for equity market to thrive. Rules and regulations that protects minority investors, strong enforcement, accountability for public shareholders, transparency of listed companies, sufficient liquidity in the stock market, participation of institutional investor, and easy access to markets for retail investors. A close relationship exists between the quality of the legal framework and the development capital markets, and investor protection is a vital part of regulatory structure. Only with better securities laws can entrepreneurs sell a meaningful fraction of their firms to the public at an IPO. The converse is also true. Insiders have higher ownership in countries with weaker investor protections. Poor securities law can keep firms away from public markets. Another problem is that currently, foreign investors own almost 65% of the free float of IC stock, largely because of relatively weak demand from locals. The share of the local institutional investors is below 10%, according to Central Registry Agency of Turkey. To address this problem, the CMB, ISE, and several other institutions have jointly undertaken an investor education campaign. The investor base can be expanded by offering better education. Finally, increasing the savings rate in emerging markets is important. More tax incentives for saving, automatic enrollment in retirement plans, and changes in the default allocation are proven ways to boost savings. The Turkish government, with support from the World Bank, is working hard to boost the savings rate, which is a top priority of the Turkish government. A last word. Turkey is the world's 16th largest global economy with a young population of 74 million. Despite the latest financial crisis, the relatively strong macroeconomy favors Turkey. The period of high inflation has ended and the economy has grown considerably. Turkey has reduced its budget deficit and outstanding debt. As economic and political stability are being restored, the Turkish capital market outlook is increasingly promising. Investor preferences and perception are improving in this favorable environment. The ICE is paying keen attention to IPOs, not only with the aim of providing benefits to firms via reputation building and access funds, but also for creating a more liquid and transparent market for public investors. Summary and conclusions. Equity market microstructure is a multifaceted literature that keeps growing, rooted in microstructure. This new field in financial economics initially focused on market maker profitability and operations, as well as on code setting as a tool for controlling inventory imbalances. Some early attention also focused on the preparation of order-driven markets. This young field expanded substantially as further early development linked microstructure to the economics of information. Financial economists recognize that in security trading, a driving reality in the marketplace is that some participants can be better informed than others, that both sets of participants know this, and that, in so knowing, the asymmetry of information affects market maker code setting and trader behavior. The chapter underscored the importance of this paradigm shift. Under divergent expectations, several conclusions emerge. First, stocks do not have strictly defined fundamental values. Second, market clearing prices can be found only in the marketplace based on the orders that participants submit. And third, because price discovery is dynamic and non-instantaneous, the process introduces noise that is manifest in the accentuation of very short-run price volatility. Price volatility around market openings in the first half hour of trading, in particular, is clearing accentuated. The chapter clarified that the accuracy of price discovery and hence intraday price volatility depends on the procedures used for coordinating the order flow and for turning orders into trade. The focus on intraday price volatility has important implications for market structures. The rules of order handling, the transparency or opacity of the market, and the consolidation or fragmentation of the order flow in particular take on an enhanced importance. The chapter assessed opening period volatility for three markets, the NYSE, Nasdaq, and ISE. Levels appears to be higher on the ISE, but interestingly, they have decreased, while Nasdaq volatility has remained relatively constant and NYSE volatility has increased. The intricate interactions between technology innovation and regulatory developments have had different effects in these three markets. Interestingly, the NYSE market has fragmented considerably in recent years. The Nasdaq market has historically been relatively fragmented, and ISE market has been and has remained partially consolidated. Market structures is critical to the efficient functioning of an equity market. An efficiently functioning equity market is vitally important for the economic growth and development of the broader economy. Equity funds will be supplied to listed companies only to the extent that they can be traded at reasonable costs and at reasonable prices for both buyers and sellers in a well-functioning secondary market. Hence, a solid, efficient secondary equity market is a requirement for a successful primary market where new capital is raised. In light of this, the last section of this chapter focuses on the ISE's challenges and successes in recent years in attracting new listing and in raising equity capital, though IPOs and secondary offerings. This chapter concludes that many of the issues involved in market structure are intricate and subtle. Understanding these complexities and developing a solid, efficient trading venue in light of them is a great importance, not just to the participants in the market itself, but for the broader economy as well.